Now comes the actual politics. Now, as you know, the latest constitutional amendment bill is called the 122nd Amendment Bill, Constitutional Amendment Bill. It proposes the following. Number one, rather than making all the 6 boxes green, it only makes 5 boxes green. One box which is completely left outside is real estate. So real estate sale and purchase will not be subject to GST. Second, even in the boxes which are made green, there are very important white islands. Which are those white islands? Petroleum. So manufacturing, refining, exploration of petroleum will not be subject to GST. Second white island, alcohol. Alcohol production, distribution, sale of alcohol will not be subject to GST. Third white island, electricity. Electricity generation, transmission, distribution will not be subject to GST. And the fourth is the white box of real estate. These are 4 important exclusions which are enshrined in the Constitution itself. In addition to these 4 exclusions, there could be other exemptions. For example, health, education, food. Technically, they could be made subject to GST, but politically they may choose to leave them outside. Even the infrastructure projects, railways, road construction, bridges, flyovers, metros, taxis, who knows? All kinds of these things can be left out from the green box and they can be made white islands. Now, one thing you should remember is that the moment you become a white island or a white box under GST, that's a punishment, not a reward. Because by becoming a white island, you think you are being spared of the tax liabilities, but no. You only are spared of the tax on your output, but you still pay the tax on inputs. And in many cases, if you pay the tax on inputs, your tax burden goes up in aggregate. And the taxes on inputs hit your bottom line. Taxes on output, you can pass it on to your customers. But the taxes on inputs go into your bottom line. They create the import bias. So, it is one of the most crucial flaws which has been a subject of debate and discussion under this constitutional amendment bill. During the monsoon session of Rajya Sabha, Congress demanded that there be no exclusions from the GST scope in the Constitution itself. But they have not reached an agreement on those issues. The second flaw of the constitutional amendment bill is that the 2% CST will not be abolished completely. It will be reduced to 1% from 2%, but more importantly, the 2% only applies to actual sales. And the government was proposing, and still is proposing, that the 1% tax will apply to both sales and branch transfers. And that makes it a lot more burdensome than the 2% CST that only apply to interstate sales. I've done a study for the steel companies, some of the major steel companies in India. I've also done for other FMCG producers. And our estimates indicate that if the 1% tax is applied to branch transfers as well as sales, it is equivalent to the 5% CST, not 2%. So the constitutional amendment bill, which is now being debated, has these exclusions. Petroleum, there are 5 products: petroleum, natural gas, crude oil, diesel, and ATF. Everything else is taxable, but these 5 products are not going to be subject to GST: electricity, real property, and alcohol. The 1% tax will be continued and it will make common market a distant goal. The base is still being debated. You have heard of the stories that NIPFP, which is a think tank based in Delhi, they have calculated the revenue neutral rates and the GST to be 27%. And the 27% is roughly 14% for the states and 13% for the center, or 13 and 13.5 equally between the two governments. Now that estimate, who knows how valid it is, how unbiased it is, but it must necessarily mean that lots of items are going to be exempt under GST. Lastly, this is the topic of a discussion for the rest of this afternoon. The processes they have proposed for registration, for return filing, for payments, refunds, they are not very kosher. And I'll go into those details a little bit here, then you can discuss them this afternoon. So with all these flaws, do you really have the GST that is going to be nirvana? I think those of you may have heard me before. I have a story to explain what happened to the GST. And I come from Rajasthan. I was told of a story that a beautiful bride got married. वो बस अड्डे पे खड़ी हुई बैठी इंतजार कर रही थी. Husband and wife शादी करवाने के बाद में they were going by bus to their some other place, perhaps honeymoon, who knows where, and they were waiting for the bus, and bus was delayed. So the bride was dressed in beautiful dress with lots of jewelry, मेहंदी लगी हुई थी सब. So all the children were उसको घूर के देख रहे थे कि देखो कितनी खूबसूरत बहू खड़ी है वहाँ पर. So poor lady was feeling very uncomfortable. So चुपचाप अपना घूंघट से उठा करके अपने पति से बात करती है कि देखो जी मेरे को सब घूर के देख रहे हैं. So she thought that she's so pretty that everybody is very curious to see how lucky this man is to have a beautiful bride like this. So poor husband, he says कि बावली घबरा मत, घूंघट उठा के अपना मुंह दिखा दे सब भाग जाएंगे. So Paras, I have my friend Paras from Jaipur sitting in the audience, and this is exactly what has happened to the GST. The initial concept of the grand bargain was indeed a beautiful bride, but in the meantime, over the past 7 years, the face of the beautiful bride has been disfigured completely, and now what is left is a story of a bride which you will have to button bazne shuru ho jayenge from the day one she arrives in your house. Now, I just want to touch upon the GST processes. The government has released discussion papers on the 5 processes: returns, payments, refunds, and registration. Now here is my summary of what's wrong with these processes. Number 1, the states are insisting that even though it is a harmonized tax, a single tax for both the states and the central government, each dealer has to register in each state where they carry on business. So companies like telephone companies, banks, mutual funds, airlines, they have to apply for 36 registration numbers. And they have to apply 36 times. It could be all at the same time, but they have to make 36 different applications for registration. Now you ask the question, what's the point of asking me to provide the same information 36 times to 36 governments? Why can't I be deemed to be registered in every state without having to apply for registration in each of the states? But without going into a lot of song and dance, they are requiring the registration to be in each state for the same legal entity. Now this has very draconian consequences. Take the example of the central service tax, for example. Right now you have one single registration for the service tax, regardless of where you make the supplies from. Under the new concept, the same services tax called the GST will have to be fragmented into 36 buckets. So you have to account for the total service tax liability state-wise, and that state-wise accounting has to be both the central GST as well as state GST. So you have to divide your central GST liability into 36 buckets. And to put salt on your wounds, if you have a situation where you have excess credits in one bucket and excess taxes to pay in the second bucket, you can't pull the two together. You will have to pay the positive tax in the positive bucket by the due date, otherwise you will run interest and penalties. And the negative tax can only be carried forward and wait for the refund if ever it comes to you. And this is not a very small, trivial matter. And there are many more consequences that flow from it. State-wise tax returns. In order for the dual tax to function, you have to provide a state-wise breakdown of your sales and purchases, because the state-wise sales will be subject to the state tax and the common central tax. Now you could have provided a single tax return where you say my total turnover is X and it is divided as follows in the following states. So this could have all been done in one single tax return as a column. You take the total turnover, divide the turnover state-wise, you take the total purchases, divide the purchases state-wise, and pay the tax on the, and you can do the subtraction addition for all of those under one tax return. No. Because you have state-wise registration, the return has to be fragmented, decomposed into 36 returns. And you have to file 36 returns. And as you have seen, for each return, it's a 4-step process. You file the GSTN 1, R1, return 1, return 2, return 3, return 4. And then you make the payments and you get everything else. So in my view, if you are lucky or unlucky to be operating in all the 36 states, you have 36 returns to file. Each return requires 4 to 5 sub-returns to be filed, some on the 7th of the day, some on the 10th of the day. No refund of ITCs on account of inventory and capital. So think of, even in a single registration return, suppose you buy inputs and your inputs are more than your turnover tax, output tax. Now in most jurisdictions you must get a refund of the excess. Excess input tax credit should be allowed to be refunded. The government has come up with a rule. The refund will be allowed only if excess credits are on account of inverted duty structure or exports or mathematical errors. No excess credit refund will be allowed if the excess credits are on account of inventory buildup or capital. Now just imagine the consequences. Now you have to divide your purchase basket into 4 buckets. Purchases for inventory, purchases for capital goods, purchases for other items which are on account of exports or inverted duty structures. You have to have an ordering rule. Which of those buckets you utilize first, and then which ones remain excess, which will be subject to refund or not subject to refund. No automatic approval or refunds. Even where the refunds are to be allowed, the government has a very complex and advanced system of cross-matching of invoices. Any input tax credit you claim will have to be verified from the vendor that yes, indeed he has paid the tax on the purchases you made. So once this cross-verification is done, which is a good thing, then there should be no delay in the refunds. The system should automatically be authorized to provide the refunds to you once the cross-verification is done. The states in particular, and the center has to go along with it, have come up with the rule that the GSTN will not be allowed to mail automatically in refunds. If a situation gives rise to a refund, those refunds have to be approved within a period of 90 days. by the center and the states. So this is, most of you are aware, how long does it take to get the refunds approved? Under service tax, even for exports, people have been waiting for 3 to 5 years to get the refund of their input tax credits, and they haven't been coming forward. And every 6 months, governments come up with a new scheme to expedite the refunds, and by the time people understand what that scheme is, no refunds are given. Now, if you have overdue refunds, you only get interest of 6%. But if you have overdue tax payments, you have to pay tax of 18% or more. Huge gap, asymmetry in the treatment of interest payments on the overdue payments versus refunds. And the last thing that is worth observing here is that the IGST on interstate sales or supplies will apply to not only the actual interstate sales but also any stock transfers. My difficulty is, how will you value the stock transfers? Because there is no price, there is no third party. So are you going to create the same sort of complexity that we face in international transactions and transfer pricing rules? So this is my very summary observation on the processes, and as you discuss those later in the afternoon, I hope that you'll touch upon some of these. You may have additional concerns about those. Now, some more thing about what is wrong with this patchwork which is embedded in the Constitution. I have done here the calculation of how much is the quantum of inputs on which the central duty, excise duty, service tax or the VAT applies, which is not creditable. So what you have here is inputs subject to cascading. This is the amount of inputs on which no credit is allowed, and that leads to cascading. This is the value of inputs. The second column shows the quantum of inputs on which no credit would be allowed because petroleum is outside, electricity is outside. Now look at the numbers at the bottom. Today, 14 lakh crore rupees of inputs. Let me clarify. I have divided the inputs into current inputs and capital inputs. So together, there are 28 lakh crore rupees of inputs on which either VAT or excise duty or both taxes apply, no credit is allowed. Half of them are current inputs, other half are capital inputs. Ideal GST should reduce the block inputs to zero. But that is not going to happen. In the case of current inputs, GST will only reduce the quantum of blocked inputs from 13.23 to 4.77 by roughly 2/3. 1/3 will be subject to the continued blockage. In the case of capital goods, the picture is even more grim. Today there is 14 lakh crore rupees of blocked inputs on account of capital, and 10 lakh crore rupees of those will face the same blocked input taxes. Biggest component of these blocked input taxes is the real estate construction. Because the real estate box remains white, no credit will be allowed for cement and steel lighting, for anything that goes into this room. No input tax credit will be allowed. Now, the total amount of annual investment in the country today is roughly 30 lakh crore rupees. Real estate capital investment is 1/3 of it, or 25% of it. 8 lakh crore out of 30 lakh crore rupees is on account of construction. And all of that input taxes will remain blocked. So for me, as a person more interested in economic impact than about the cosmetics of the GST, this is the real story. This one slide summarizes to what extent the GST will benefit the economy or not. The next picture is about the tax rates, R&R rates under GST. You have all the tax rates that are going to be replaced by the GST. The union excise duties, excluding petroleum products, because petroleum is outside the GST. You have the service tax revenues, state revenues, the 2% CST, all of those taxes which are going to be replaced by the GST amount to, it's a surprise to even to me, 5.18% or 5.14% of GDP. There's so much talk about the tax burden in India, but look how little they contribute to as a percent of GDP. All of the state VAT, excise duties, service tax revenues, their contribution to the final bottom line of the governments is 5.14 or 18% for 2 different years, roughly the same percentage. Then you ask the question that if you want to raise revenues equal to 5 and say 0.5% of GDP, what tax rate do you use? This is the next calculation. In that particular year for which I had done the calculations, the total GDP was roughly 100 lakh crore rupees. Of that 100 lakh crore rupees, GST base, which consists of private consumption and government consumption, was 60 lakh crore rupees. In the GST base is roughly 60% of GDP if it is comprehensive. Now you do a very simple calculation that if you want to raise 5.5% of GDP and your base is 60% of GDP, what tax rate do you need? Less than 10. Because the 10% tax rate, if the base is comprehensive, is going to give you 6% of GDP. You only need 5.5%. So when the Finance Commission did the calculation of the R&R being 11 to 12% or no higher, it was based on that calculation. And even to this date, calculations haven't changed. Years have changed, the absolute numbers have changed, but the percentages remain the same. Only reason that tax rates have to be higher is because the base is narrower. If you are not able to tax the full 60 lakh crore rupees of the GDP under GST, suppose you can only tax 45 lakh crore rupees, means 25% of the 60 lakh crore rupees is tax exempt for some reason. Even then, the tax rate only goes from 8.6% to 11.5%. In order to hit the tax rate of 26-27%, you must assume that 75 to 80% of the consumption will be tax exempt. Because if the base is reduced from 60 trillion or 60 lakh crore rupees to 20 lakh crore rupees, which is only 1/3, then only your tax rate goes to 26%. This chart shows how the different sectors of the economy will be impacted by the GST. So, as I mentioned to you before, GST can help the impact on your sector through capital deepening, which is called the capital box, or factor productivity improvement, which is the productivity box. It can also have an impact on the total demand in the sector, because if the total tax burden comes down on your sector, your demand may go up or may go down. Now, petroleum and gas belongs to the red box. Because petroleum and gas will be outside the scope of GST, all the capital investment in that sector will be subject to input tax, which is not recoverable. exploration, development, refining, distribution, retail, all of those activities in the petroleum sector, gas sector, will be subject to tax, which will not be recoverable. As a result, those are red boxes, means no improvement. If anything, the productivity may go down. On the demand side, there will be some improvement, not some improvement. Just ignore the demand column. Electricity. Now, think of the following. Solar panels. Suppose you want to buy clean tech. Today you can buy solar panels tax-free because there is an excise duty exemption for solar panels. Wind turbines have exemption from excise duty. Tomorrow when the GST comes, all these exemptions will disappear. Solar panels will become, if the GST rate is say 20% more expensive. Wind turbines will become 20% more expensive. Poles, transmission lines, major generating stations, all of them will become 20% more expensive with no rebate of input taxes under GST. So they are going to suffer a big hit under capital deepening as well as productivity improvement cycle. Construction, it's a green box. By construction here I really mean the construction services, not the buying and selling of buildings. So the builders who are simply providing labor for building a building, they are basically manufacturer service unit, so they are happy because they'll be able to recover the input taxes fully. Manufacturing. In the case of manufacturing, the long steel as opposed to flat steel. Long steel mostly goes into construction and no input tax credit will be allowed for the long steel. So those industries are going to suffer because their output will bear the GST with no recovery of input tax to the buyer. So on the demand side, the demand for long steel, cement and gas may go down because those products will become more expensive than otherwise. Retail, let me see, finance and insurance. Anyway, I think it will take me too long to go through the chart, but you can analyze the impact of GST sector by looking at these three components. What happens to the cost of your investment in the given sector? Are input taxes recoverable or not? What happens to the productivity in the sector? What happens to the output demand for the sector? As of now, with all these flaws which have crept into the GST design, the GST, which was called the game changer, has become a name changer. The game is nothing more than changing the name. Worst, that now you are going to be sleeping with this bride or the groom for the rest of your life. And the best part of that wedding or co-living will be the day of the honeymoon. The day the honeymoon is over, there will be constant tangle. So the GST is a fun thing if it's a tango, if the two parties cooperate and work for the common good. But like most marriages, it may turn out to be a tango. So this is perhaps the reason it has taken the government 7 years to debate the GST, fate of the GST. And who knows whether we'll have the GST in another 2-3 months or we'll have to wait for another 2 or 3 decades. Thank you.